You see, when you can identify where liquidity sits in the market, you can basically understand the magnet areas where market is going to be drawn to, which means you can take a good trade with clear targets, knowing fully where you understand what the big players are doing and identify reversal points in the market also. So in this video, I'm going to show you three forms of liquidity and break down what liquidity is and how to trade liquidity with supply and demand. As you guys know, I only trade supply and demand. And at the end of this video, you won't know how to trade liquidity at a very high level. So let's get straight to the video. So what is liquidity that we're talking about? Liquidity is refers to orders on money. Market moves based on the flow of orders. As you all know, when there is much buyers in the market will go up, and when there is more sellers in the market will definitely come down. And when there is no significant movement in the market accumulates order, which brought about liquidity. As we all know, the bigger players need liquidity to execute their orders. They need large amounts of liquidity to execute their orders in the market. So in this video, I'm going to show you guys how to trade with liquidity, avoid liquidity traps. There are three different ways to identify liquidity clearly, so we can use them with our trading system for a better result. And these three forms of liquidity are equal low and equal high liquidity, trending liquidity, and the ranging one. The most common liquidity you won't see on the market is the equal high and the equal low liquidity and the trending liquidity. The one on the left side is the equal high liquidity, and the one on the right hand side is the equal low liquidity. So that form of liquidity you're going to look at is the trend line liquidity and the ranging liquidity. The ranging liquidity is not that too common in the market unless the big players are trying to accumulate a huge amount of liquidity. For the equal high liquidity, for example, as we all know basic understanding in the forex industry, some traders that trade support and resistance, as they have seen here, price tap here and reject, came back again, tap and reject. They will be positioning for another sell here once the price tap here, thinking that the price will tap here again and reject from here. But as we know, here is a liquidity area, this equal high. The market will definitely come here to take out their stop loss before moving the opposite direction. And some breakout traders will also be wanting this to happen. They'll be wanting this to happen. It will stop at the both parties that are wanting to buy or sell. So in this scenario, once we see the clear picture, knowing that market is bearish and we want to sell, we wait for the market to take out the liquidity here, coming back here to break this structure, changing character, then we enter from here, targeting the opposite side, something like this. Same thing applicable to the equal low liquidity. Don't join the traders in selling equal high or buying at equal low. If you see an equal high in the market, the next step will be wanting to sell, but you have to wait, because sellers that sell at resistance keeps their sell stop order above the resistance. The market will definitely always want to take it out before moving the opposite direction. Traders like me and you, the retailers, you understand, you only make 5% of the market movement, and the 95% is from the higher institutional traders with huge amounts of money, and they can't just enter trade right away. So they need to get to the areas of liquidity in order to enter their positions. That is why the liquidity is field always sees as a sharp movement in the market. The liquidity always moves fast. You can't just catch. But if you're able to catch the move, you will definitely make a higher risk to reward trade. So how can we use this as to our advantage in the market? First of all, don't sell at equal high or equal low, because you have the higher risk of being stopped out. Secondly, we can use them to enter a position, or we can use them to target. You can also target liquidity in the market when you see liquidity. For the trending liquidity, for instance, this here is a break of structure. This here is also a break of structure. This here is also a break of structure. So as the market is making consecutive break of structure, the bigger players will look further for a liquidity to carry on their uptrend. So what they will do is that once the market tries to come down here, it will make a fake move up, coming down to take out this liquidity before going up again. In this form of liquidity, we call it trending liquidity, because as we see, this is a trending market. We are going bullish. So for them to have the enough momentum to carry on their activity in going up, they have to grab the liquidity before pushing up again, to have the full power and momentum to go up the right direction they are going. So let's get to the chart to see more examples on this liquidity and know how to fully trade it. So for this liquidity example on the real charts, I'll be using USDJPY. This is 15 minutes time frame for the example. As you all can see, we're on a downtrend, market moving low. Again, if we zoom out small, you can see the current movement of the market is downtrend. We are moving low from here down here. This is a downtrend. This is a downtrend. We are moving low. We have to look out for the recent break of structure to follow the trend. Here is a good supply zone. This is a good supply zone here. Here, see supply zone. Here again, this is supply zone here. The supply zone here. As you can see, it broke this structure here. Broke this structure here. Broke it. So we are waiting for pullback here for it to come down again to break the structure to maintain the downtrend. So let's play. As we can see, the market tap didn't tap our supply zone here, but it came down here, came back here, and broke this structure here, So as a retail trader, we are we look out for the recent breakout structures to enter the market. So many people, for instance, can come down with, for example, some people will be looking at to enter the market somewhere here, thinking here is a good supply zone to enter the market, forgetting this supply zone here hasn't been tested or mitigated before. They will be willing to enter the market here for the market to pull back here and go down more. It really did made a reaction here, showing that this place is a good supply zone, though it's also liquidity. As you can see, the price swell with liquidity here, tapping to our normal supply zone here. So as a trader, you have to wait for the price to sweep the liquidity first before entering the market. If we switch down to the 5 minutes time frame, you can look for a change of character around this area to roll down with a sell. So as we switch down to the 5 minutes time frame, this is the 5 minutes time frame. This is going to be on the 5 minutes time frame. This is the leg that took out the liquidity, and came down, switching from bullish to bearish. It tapped the supply zone, switching from bullish to bearish, breaking here, price broke here. So we are waiting for any pullback now from here, to join the market and target the nearest week low here, target here on the 5 minute time frame. So let's play it. Market came back, as we can see here. Also, market took our liquidity here before giving us this massive drop, bearish candle here, dropping this massive bearish candle here. As a trader, I've seen this as a valid change of character here, and also a support here, a resistance here. Use this as a resistance, then I can peacefully enter my sell position here. Peacefully enter my sell position here, putting my SA above here, and targeting down here, or even this week low here to play the trade. I see. To our profits. This is how you trade with supply and demand using liquidity concepts. With liquidity concepts, you can understand the institutional footprints in the market, know how to navigate, know how to go about. Liquidity is a powerful tool in the forex industry.